Good morning. It's Tuesday, October 8th, 2024. It's just after 11:30 a.m. on the East Coast. This is Rob Sin at CEO Technician on X, at Goldfinger on CEO.ca, and this is Goldfinger Capital. Today's video, I'm going to delve into gold and silver, talk about the correction that has gotten underway in pretty much in full force today. Some of the observations I've made about the gold and silver market in the last couple of weeks, including around sentiment. I think these are really important observations I'll be sharing. Definitely some learning that can possibly save you money in the future or even make you some money. Talk about my downside correction target for gold, why we should embrace the correction, and why the gold miners could be setting up beautifully for a trade later this month heading into quarterly earnings reporting season. So as usual, if you like this video, if you get value from it, if you like my content, please hit the like button, please subscribe, share this video, and it will help me to get the best guests on this channel and the best content that I can possibly produce. I appreciate you very much for doing that. So let's get right into it. We recently saw an unusual divergence in gold and silver. And let me try to explain this. It started, I would say I started observing this at the end of September. So I wrote this blog post on my Substack on October 1st, so exactly 1 week ago, last Tuesday. And the point of writing this, for me, is that this was unusual. In my opinion, this was unusual that we were seeing all these investment banks raising their gold price targets. And in September, there were multiple price target raises from multiple investment banks, including from UBS, including from Goldman Sachs, including from Bank of America. And they're all sort of singing out of the same songbook, right? Like, we know the structural reasons why gold is in a bull market, and we've known it throughout 2024, right? There's nothing really new, except they seem to be saying, well, Western investors are now joining the party, so gold's going even higher than we previously thought, right? And that may well be true, but what concerned me is just how many price target raises there were in such a short period of time. And I couldn't help but notice that the commitment of traders' position in gold futures, and obviously, you know, this is kind of opaque, and there's lots of off-the-books trading going on, right? Also through options, lots of different ways to hedge, physical market, options market, futures market, ETFs, right? So you need to really put the whole picture together, and sometimes it's very hard to do that in commodity futures. But I couldn't help but notice that swap dealers got, hugely short here in September, and they've been getting shorter and shorter all year, as they often do in a rising market, right? But it's like, do what I do, not what I say, right? And they're all raising their price targets, but they're also, the swap dealers are UBS, Bank of America, JP Morgan, right? They're the big investment banks. So they're shorting, but their analysts are saying prices are going higher, right? And so just a blog post, a little thought-provoking, like, this is an interesting moment in time. And generally speaking, I don't think it's a bullish phenomenon to see all these investment banks raising their price targets at the same time after gold has rallied, $400 in the last 3 months, right? So that's why I published that, right? This was not a bullish blog post, okay? And then, we're seeing gold start to make more and more headlines. In fact, I pointed out last weekend, not this last one, but the weekend before, that Barron's had 3 gold articles in that edition of Barron's. Now, they weren't all bullish, but gold was on their mind, right? Gold is getting attention. Gold is getting clicks, right? And CNBC is, of course, talking about gold more frequently now. And, in social media, you sort of, after you've been around a while and you see how the ebbs and flows of retail investor sentiment, a lot of people suddenly started talking about a silver breakout last week, right? Like silver's testing up near $32, $33 an ounce. If it breaks above 33, it's going to 50, right? I saw a lot of people saying the same thing. And then all of a sudden, we got this article, actually it was reported on Bloomberg, and then it was blogged a couple of times, basically reported that Russia's going to boost its silver reserves. But there weren't many details in this, and quite frankly, the total notional amount that Russia proposes to spend on precious metals in 2025, that's not this year, this was about next year, is still less than $1 billion, right? So in the global metals markets, they're talking about gold, silver, palladium, platinum. In the grand scheme of global metals markets, $500, $600 million of buying spread out over a year is not a significant news story. It's not really going to move markets, right? But this caught a lot of headlines. And obviously, there's a certain fan club of Putin and Russia in the precious metals community, so they ate it up. They loved it. Well, on my Substack, this was my takeaway, basically. Color me skeptical of these reports. And actually, often we get bullish news reports about a given asset class or stock coming out after that particular asset or stock has risen a great deal. This gives professional investors cover to sell and take profits. Okay, so that was my takeaway last weekend. I wrote this in a premium post. I'm sharing it here in this video because it's old news now. But my takeaway was I wouldn't really view this as a bullish thing until it's proven that this is real and Russia is actually stockpiling silver. And other central banks are following their footsteps, that silver is now, a reserve asset. If that actually comes to fruition, then it's a very significant news story, right? But right now it's speculation and we're lacking details, right? So I saw this confluence of events where sentiment was staying very bullish, but we were starting to see gold and silver downtick a bit, right? The technical structure wasn't quite as compelling, right? And, I guess the final thing I'll throw in about this is gold was remaining relatively well bid last week, near 2670, 2680, even 2690, while the gold stocks were beginning to move lower, right? We were seeing actually some pretty big drops in the mid-tiers like Wesdome, like IM Gold. I mean, this really got going this week because they got some fear, uncertainty, and doubt from Burkina Faso. But we were already starting to see the gold miners move lower as gold remained pretty well bid near 2670. And I even pointed that out. And actually, it's kind of hard to see because these are just little screenshots from a private channel. But I basically pointed out last week that the gold miners were clearly trading down and gold wasn't following suit. Usually not a positive sign for the yellow metal. Usually the gold miners are actually going to be leading gold itself, especially when geopolitics are in play, right? So we know that geopolitics affected the market last week because of the move in crude oil. Going from 66 to 78 in 1 week is an enormous move in crude oil futures. A lot of that, basically probably all of that move, had to do with fears that Israel was going to attack Iran's oil facilities, right? Well, now that trade is unwinding a bit today, and gold is unwinding with it, right? So we know We can clearly assert now, based upon evidence and market price action, that there was a geopolitical risk bid into gold that is now being unwound a bit. How much was that bid? Was it $50 an ounce? Was it $60 an ounce? Was it $70 an ounce? I don't know. But clearly, based upon today's action, there was some Iran risk bid into gold, and that is being taken out of the market. It's being taken out of the oil market too. And generally speaking, geopolitics for gold is kind of a fool's gold. Yes, it creates short-term price movement. So if you're a trader and you're nimble and you can buy and sell quickly, fine, just trade it, but don't hold through it, right? Because once the event happens, it's like 98% there's going to be a reversion to the mean, right? Basically, it's going to completely unwind all of the amount that it had moved on that event risk, right? When did the event risk start? I don't know. Maybe, mid-September, early September. So, it could have further downside to 2,600. Hard to say right now. I'm going to talk about my gold correction downside target in a little bit. But simply put, we saw in the last week a divergence between the health of the gold and silver markets, technically speaking, and investor sentiment that seemed to stay bullish or even get even more bullish as price was not confirming and the miners were turning lower, right? So that's a bearish divergence, and it's proved to be a pretty strong indicator here, this week as the miners get hit even harder and gold and silver sell off. Another thing is that, bull markets climb a wall of worry. When we reach a cheery consensus among market participants that this is a bull market and it's going up, that's when you want to be concerned, right? And I feel like we kind of got there last week in precious metals. We kind of got this cheery consensus that these are bull markets, people starting to chase these moves, and that's when you want to be really concerned and take some off the table and maybe even hedge downside risk. You never really want to be in a cheery consensus trade where everybody agrees it's bullish, right? And a lot of these, it's interesting because the Costco gold buying headlines are interesting because in a sense, it's bullish. The Costco gold and silver buying frenzy, I guess you could call it, is bullish because it's creating a much bigger buying interest among the public, right? So now the gold market is available to a much larger swath of potential buyers thanks to Costco. So that's bullish. That's positive. It's raising more awareness for the gold market. Even like the Barron's articles talking about how you shouldn't buy gold at Costco because there's a bid-ask spread when you try to sell it and the tax implications, yada, yada, yada. Don't take it out of the case. But at least they're raising awareness for gold as an investment vehicle and that you can actually buy physical gold. That's positive. But on the flip side, it's like, probably people buying the maximum amount of gold bars they can via Costco in large numbers is probably not a sign of a market bottom. It's probably a closer to the top. I'm not calling a top here, but I'm saying it's a sign of a more advanced market rally, right? It's not the bottom, right? The bottom, we know the bottom. 2015, the end of gold, the death of gold, cover on The Economist, or 2017, John McAfee saying gold is worthless and Bitcoin is worth $1 million and he would eat his own dick, whatever. Like those kinds of stories, those are the bottom. That's the bottom. That's when you want to get aggressive, but that's when it's the hardest to buy psychologically because it's not popular. When the trade gets more popular, well, you're in a bull market, but where are you in the bull market? Are you in the 6th inning? Are you in the 7th inning? Are you in the bottom of the 9th inning? Are you in extra innings? It's about to roll over and really fall hard any moment, right? That's what you have to gauge as an investor, and that's the tricky part, right? So, frankly, I'm not taking any victory laps here. I turned bearish on gold last week. I think that was probably pretty clear to anybody who follows me, definitely any premium subscribers. But now what, right? So what, now what? I'm going to talk about that next. But I also want to emphasize why. Oh, and also I want to make another point here that basically the gold miners are trading with a very strong negative correlation to Treasury yields. So basically, if you think Treasury yields are going lower, gold miners are a great trade. If you think Treasury yields are going higher, gold miners are not a good trade. You don't want to be long gold miners. You can see the correlation has flip-flopped definitely a few times here in recent months, but right now, we saw yields bottom in mid-September. We saw gold miners peak a week later. Treasury yields have risen pretty sharply in the last couple of weeks. Gold miners have fallen in the last couple of weeks, right? So it's a pretty clear negative correlation. I don't know whether it's negative 80% or negative 85%, but it's pretty clear negative correlation. And that's the trade right now. That's the trade. If I just look at the 10-year yield chart, I see the resistance up near 4.15 to 4.2%. We're not quite there yet. So there could definitely be some more downside in this move in gold miners, and I want to encourage viewers of this video to embrace that because it's going to set up a fantastic trade in my assessment in the next couple of weeks, and hopefully I'll be here to narrate it and identify it for you and as close to real time as I possibly can on this YouTube channel and on my Substack. But I just want to make that point. Basically, gold miners are an inverse Treasury yields trade right now. And so the fact that the 50 basis point cut in November is off the table has been a very clear negative for gold miners in recent days. And now that, it looks like it's 25 for sure, but there's even a probability of the Fed standing pat in November now, right? So we flipped from 50 basis points being like the 60-40 probability to 50 is not even in the conversation anymore. 25 is the likelihood, but there's maybe even a 10 or 15 or 20% chance the Fed stands pat. And that's just where we are. And frankly, you'd rather express a bullish view in precious metals when the Fed rate cut expectations are lower than when they're higher and there's more of a risk of a disappointment from the Fed. But anyway, okay, we talked about the bank price targets. Don't really want to talk about this. Let's talk about breakouts in miners, right? So I chose 3 examples because they're examples that are particularly timely for events that have happened in the last couple of weeks. So core mining, everybody's favorite high beta gold and silver producer, obviously was in a very clean uptrend. It's still in an uptrend, but obviously it's been dropping in recent days. Very clean uptrend, and it was breaking out above this 750 level at the end of September. Actually a pretty significant long-term level. Definitely some momentum on the buy side there. Well, and then it just completely fizzled out, and last Friday it gapped lower, dropped 10%, and it's been dropping, it's been grinding lower so far this week. So that's an example of a gold producer, silver producer that had a very big move year to date, was making new 52-week highs, was looking like it was breaking out, technical breakout, everybody draw your charts, and then it just completely fizzled. Well, they made an acquisition. They made a $1.7 billion all-stock acquisition that just completely killed the rally, right? And this is what happens in the mining sector. That's why veterans, pros, only really buy miners on dips, on sell-offs, when they've been trading lower, right? You don't chase a 52-week high in a gold or silver producer. You just don't do it. Because more often than not, they're going to do a financing, do an acquisition with their stock, or even with cash. It's still going to be perceived as a negative in the near term by the market. or they're just going to put out some bad news, right? And you always have the gold and silver price risk. You have it both ways. It can go up, it can go down. So we won't even talk about that. But chasing breakouts in miners is a losing bet longer term. Okay, it's just really as simple as that. It's one thing to ride a trend and to get in at a certain price. Let's say you bought core at 525 and you were just riding the rally. Longer term, you're expressing a longer term view on the price of gold and silver or the company, and you just sort of let it go, but your cost basis is down at 525, so you're way in the green, right? That's one thing. It's a whole other thing to start a new position at 750, betting that it's going to go to $8 or $9 in the near term, right? Odds are not in your favor there. RIO.V, so this is a junior uptrend. Great performer year to date, good company, good CEO. Well, they put out great news last week. They got their permit for their project in Chile. They got their permit. They got what they've been waiting for, what they've been working for. They got it. Well, look what the stock did since the announcement. Right? It's basically what gapped up that day. It's dropped since the breakout price. It's actually lower. On net from the day before, it's still slightly up. But if you bought it at 70 cents or, God forbid, 72 cents, you're down 10%. Right? If you bought it on the news, you don't chase the news. You don't chase the breakout. You got to think that when news is announced, there's a very good probability that a significant percentage of market participants were already pricing in that news release. They already knew it was coming. They didn't have necessarily inside information, but their trade thesis, their investment thesis was they were going to get the permit or the drill results were going to be good. That's why the stock was up. So it's a liquidity event. It's a sell on the news event. So professional traders take profits into that buying burst to 52-week highs on the news release. So you get a failed breakout. Failed breakout in core, failed breakout in RIO.V. And VZLA, another example. I mean, look at these green candles here at September. Boom, 3 big bullish green candles in a row. It was moving up above its summer high. In Canada, I think it was the $3 level on the TSXV. On the AMAX, it's a little different because of the exchange rate, but it was definitely above $2, getting up to $2.20. And then they announced the financing. They announced a $65 million financing, right? You can see the gap down. 10% drop overnight. And now, it's moved around. It's not down big or anything, but so much for the breakout, so much for chasing the strength, right? You get punished for chasing the strength in the mining sector more often than not. And that's just rocks are hard, water's wet. That's just me telling them like it is as a guy who's traded these markets and seen it and made the mistakes and learned from it, right? So 3 examples why you don't chase breakouts and why you don't necessarily chase news flow. Right? Okay, so let's talk about, so here we are today. We've talked about the past. We've talked about the bearish divergence, Treasury yields, negative correlation to miners. So what's the downside correction target for gold? I want to say that 2,700 was a big upside level. It's a level I've been talking about since early 2023. We finally got there. This is a big move, guys. Like, this is a big move. I mean, if we look at this since the beginning of the year, gold was below 2,000 earlier this year, briefly for a couple of days, but it was below 2,000. 2,700 is a 35% move. A 35% move in 1 year for gold is a very large, outsized gain. It's not something that happens very often. So we have to put things into perspective here. Regardless of whatever, the Treasury budget deficit, the debt ceiling, Iran, Russia, China, stealth buying, Saudi stealth buying, the narratives are always going to be there. This is a very large move. So a correction is actually very healthy. Rebuilding that wall of worry, getting some people out of the market, punishing chasers is very healthy. So there is some minor support at 2620, and we're sort of like testing that here already, right? I mean, this is a pretty big drop today. We could see a bounce for sure in the near term. But, you know, looking at this bigger picture, I think 2575 is my level. I think that's the real downside target for this correction. And if that's where we get to, and that's it, that's fantastic. That's a pretty standard, par for the course kind of stuff. 5% drop, healthy. Obviously, we could go lower. 2525, 2500 down here, testing these early August levels, definitely within the realm of possibility. But I would say my downside target is 2575 for this correction. Okay. And, you know, looking at this bigger picture, you know, looking at the monthly chart, this is a very powerful breakout, and a 5% drop from the high does not change anything about this chart pattern and about the potential for more upside to, you know, possibly 3,000 either later this year or next year, right? So we have to put things into perspective. 2575. Okay, so that's my level. Embrace the correction, because I believe gold miners are already well into the correction, as we can see. Look at the GDXJ chart. Look at the GDX chart. We're already at the 50-day moving average on the GDX. And notice that the GDX has this tendency to actually drop through the 50-day for a couple of days, 2, 3, maybe 4 days, and then rally powerfully. Right? It's done. It did it in June. It did it in early August. It did it in early September. And here we are again. So very, very possible that we could fill in this gap here in the GDX down around 3750, drop through the 50-day, wash out some more traders, and then find our support level. Okay, so it kind of lines up. 2575 to 2600 in gold over the next week or two. 37 to 3750 in the GDX over the next week or so. But we have to realize that probably the gold miners will bottom before gold does, and they'll start to turn up first, just like they turned down first. Wesdome, high quality company, very high quality operations, extremely high grade gold ore bodies, big profit margins, low cost of mining. Well, this has been dropping for 3 weeks. Right, so even as gold made a higher high and it stayed up near 2,700, Wesdome was trading down, right? So that's a powerful tell. And some people will look at this and they'll see a head and shoulders top, but I'll tell you, this is not a valid pattern, because the highest volume is on the right shoulder, the lowest volume is on the left shoulder. It invalidates this pattern. Now, I'm not saying that $12 support level isn't important. This clearly is. But this is not a textbook head and shoulders pattern, and I wouldn't project downside to whatever, $10 or $9.50 based upon a break of this support level. Okay, I mean, that's just my take on it. I am gold again. This has gotten hammered in the last week, quite frankly. This is still one of my top picks. This is an M&A candidate. Some negative news out of Burkina Faso, but I think you hold your nose and buy this in the green zone. Apologies to anybody who bought it higher and got blindsided by this news report from Africa. Hopefully this does not happen. They're not nationalizing gold mines in Burkina Faso, but it certainly is scary. But those who can see through the FUD, this could be a tremendous opportunity. But the green zone really is the buy zone. That's the real support in this chart. And then Newmont, right, the world's largest gold producer, they will report earnings after the market close on Wednesday, October 23rd, followed by a conference call the next morning. So they're going to really kick it off for the gold sector. And, this I wrote October 3rd. So even as I'm turning negative on gold and silver, I see the incredible profitability of the big gold miners like Newmont. And especially in the case of Newmont, I invite you to read this blog post. It's on my Substack. It's free. It's freely available. Especially in the case of Newmont, they're going to be doing well at 2,400, 2,500, 2,600. They're going to be extremely profitable. Q3, I believe, and the point I make in this blog post, I believe they could potentially generate $1 billion in free cash flow, $1 billion free cash flow quarter on Q3. Don't hold me to it. I'm not their CFO, but based upon my analysis, based upon the average gold price in Q3, based upon the synergies from their acquisition of Newcrest, that costs are forecast to drop in the second half of this year, they could potentially actually do that $1 billion in free cash flow. And then they're even saying Q4 will be an even better quarter. Now, obviously, that does depend upon what the gold price does for the rest of this year. But UBS basically put it on its focus list, which when an investment bank like UBS does that with earnings a month or 3 weeks away, that's a sign that they believe it's going to be an earnings beat. Okay, I mean, when they do that with a retailer like Lululemon or a Target, it means that they have info through their channel checks that the margins are going to beat and the revenues are going to be strong. So that's my thinking, regarding what they're thinking with Newmont. So remember, we don't want to buy these stocks at 52-week highs, right? So even though I see a bullish quarter coming for Newmont, I'm not chasing it at 55 or 56 or 54. I want to get that fat pitch. I want it to come down to my level, which would be $50 a share in the next couple of weeks. If the trade sets up, be patient. If it sets up, if the opportunity presents itself, I think this could be a great trade into the earnings report, as many of the other big gold producers could be as well, like AEM, like Kinross, KGC, and potentially even IAM Gold. We have to look through the FUD and the risk that suddenly reared its ugly head, but I still think this is going to be an M&A candidate. I think it is an M&A candidate, and I think really their bread is buttered in Canada with Côté, and to a lesser extent the Nelligan project, which is 6 million ounce potential gold mine that'll be an open pit mine. All right, so, and then there's the final point. So embrace the correction. Seasonally, this sector often drops in October, so the fact that we're seeing downside here in October is nothing new. And it often bottoms at the end of the month, so it'll probably bottom right around the time these big miners like Newmont, Barrick, Kinross are reporting earnings at the end of the month and into early November, and then we usually have tailwinds all the way through February. So you see the seasonality becomes favorable at the end of October, and it stays pretty favorable for the next few months. So embrace the correction, embrace the pain in the near term. Obviously, manage risk, size positions accordingly, and try to wait for the fat pitches. Don't be impulsive, okay? That's really the most important thing as a market participant. It's being patient, waiting for the setups to arise. You don't always have to do something, right? You don't always have to be in the market. So that's it for me. Again, if you find value in this video, if you like my content, if you want to see more of it, please hit the like button, subscribe, and share this on social media. Have a powerful trading week.